Hello, I'm Tony Kaye. Welcome to the Economic View. I'm joined by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Very good. Happy birthday.
Thank you. Thank you very much. Yes.
Thought I'd drop that in straight away.
Another year older, another year wiser, apparently.
Well, let's hope for that.
Let's hope so.
I'm confident. But let's talk about data out this week. So we've had wages data. Mm-hmm. Let's talk about that first off.
Yeah, and the word you used there was confident. Is probably a word I'll pick up off the back of wage numbers yesterday that we saw. They were as expected, so they were forecasted to be weak quarter on quarter. So Q2 grew by 0.5 of 1%. Year on year, that's 1.9%, year on year. That is still a record low. So it's the lowest rate that it's been growing at since basically records began, which is about 25 years ago. That quarter on quarter growth is just above the worst one we've had. What you then need to do is drill into it, look at private sector wage growth, and it's really poor. It is and there's no other way to sort of call it anything else. 0.4 of 1%, and looking at around about 1.5% year on year. That's really, really low, and it explains why consumer confidence is so weak at the moment. Everybody highlights, and there's a chart that we'll show you today that shows that business confidence at the moment is hitting post GFC record highs, whereas the other side, consumer confidence, is going towards not record lows, but the gap between the two is at record gaps, and that's a real dilemma, because if the other thing, getting back to that core figure of that 1.9% year on year growth, if you look at inflation and you look at the average weight, so let's look at the trim mean numbers, inflation is 1.8%, which basically means people are only getting inflation CPI put into their wages, and that's it. So yes, it doesn't include bonuses, and that's all well and good, but bonuses are discretionary. And if you have a look at what's been going on inside the earnings season so far, bonuses probably will be okay for some. In the main, it won't be. So again, if you look at what happened inside those numbers, drill into the actual sectors themselves, look at mining, look at finance, which is where the big bonuses are, they were backwards. So yeah, yesterday's numbers were pretty grim reading in that respect.
And then obviously the flow through from that is that people are less inclined to spend.
Exactly.
Flows right through the economy, into retail, housing market.
Flows into, all that. I mean, the glad you highlighted discretionary, because it's where you initially see that reaction in a market. So the market's reaction normally comes over the next 2 or 3 days in discretionaries, because disposable income is clearly under pressure. Interesting, if you look at the GDP figures, consumption's been okay. So this is some of the push-pull factors behind it. But you can now look through on an average basis 12 months, and you can see that wage growth has been like this for at least almost 36 months, and it's not improving. And that therefore means that you can put that into the retrospective GDP figures going forward anyway, and they therefore are going to show that C side, that consumption side of GDP, is likely to be under pressure. So who picks up to get GDP towards what the RBA wants, which is 3%? That has to be private investment or government expenditure, maybe, of those two. We know that having a look at the CapEx numbers on the private side, they haven't really shown any signs of wanting growth, despite the confidence side. They haven't actually put capital away for future expectation. So that means trade balance has to come into it. Now, trade balance has rescued us in the GDP figures over the last couple of quarters. So that's the interesting thing out of, again, yesterday's wage numbers. So yeah, it's an interesting dilemma about how you stimulate that part particularly.
And then if we go back to what the Reserve Bank minutes said earlier in the week, these are some of the issues that it's contending with in its decision making.
Yes, it is. And that was sort of said in the statement back on the 1st of August, but the minutes just clarified exactly what we discussed actually in the Economic View back then. Was clearly the FX headwind is a major problem for them, and they are fairly aware that it's probably more likely than not to be more elevated than they want it to be for the foreseeable future. They do clearly point that they want to raise rates, but at the moment, wage growth is a massive headwind for them as well. So Philip Lowe's on his own. He really, he's got one monetary policy mechanism really, and that's rates. And the way I've always described interest rates, it's a sledgehammer trying to do fine art. And the reason for it is that when you move rates, it applies across the entire economy. Whereas there are parts of the economy that are booming, and there are parts of the economy that aren't. There are certain sectors of the economy that are booming, and then there's certain sectors that aren't. And you can't reach that just using rates, because you'll cause those ones that are already doing very well to just accelerate further. Housing, prime example. or those ones that aren't getting it just won't see the pickup, which is something like filtering through to wages or filtering through to other parts of the economy that need it. Stimulation in probably infrastructure is another part of that. I mean, infrastructure is growing, but not at a rate that probably needs to be there. So he's got a very interesting tightrope, and that's what came out in the minutes. Is clearly FX is a problem, household debt is a problem, and wage growth is a problem. And we need to see that move. But again, the reality overall is that if rates are going to move anytime soon, it's going to be up, which means that they're probably on hold now for the foreseeable future. And my future, when I talk about that, is 12 months. So we're talking about August 18, and we're probably not going to have to see a rate move, and it could be the longest period, basically since the in the RBA's history of not moving rates in either direction. So,
and even if you look out, 12 months. Consumer confidence still very low, wages growth still very low. So
inflation's still very low.
Yeah. So whatever the Reserve Bank does, I mean, it's got to be very mindful of that. If rates start going up, which they already have independently of the Reserve Bank anyway, but if rates go up even further, then it's going to put extreme pressure on households.
Yeah, it is. And look, the one thing that I think the RBA was also alluding to in the minutes is that the macroprudential regulations they've brought in is working. So one part of the market that they were really worried about getting back to that sledgehammer rule is the housing market. So clamping down on interest-only loans and particularly investor loans has cooled the market. It hasn't popped it like I expected it to be. It was a frothy situation, and it's curbing. And that's what you'd want to see. That's how the RBA very much wants this to be. It's just to curb, take the heat out of that side and stop the leverage going on the upper end, where basically don't worry about the principal, let's just get the interest and get the investment idea, get the growth and flick it out. That is what they were worried about, because even the banks themselves are starting to tell you that. What's interesting about that, and looking at again from a micro side and looking at what's happened on the earnings side, look at what the banks have reported to you this earnings season, whether it's their quarterly updates from NAB and ANZ, or look at what CBA are telling you. Bad and doubtful debts are getting back to record lows. In fact, CBA told you a record low in BDD. So that's the interesting part of this, is that although rates are low and the risk therefore is that people are over leveraging themselves, the management of it is also doing okay according to the banks. What the banks also say though is that they were to see an increase of 50 basis points, 1 in 3 families would find themselves under extreme pressure. So this is the push-pull factor, getting back to those minutes, is that the RBA is acutely aware that, again, raising rates to slow down certain parts of the economy, and there are parts that are certainly moving, and that is a clear given fact, and that's fine. What happens, though, is that will it therefore, as we said with wages, will that not only cramp consumption, will it completely reverse it? Because if you all of a sudden saw a 50 basis point increase in your mortgage, and the average mortgage, particularly in Melbourne and Sydney now, you're looking at is between $450,000 up to $650,000. That's the average in that range. That's a huge increase per annum to be paying. So there's all of that comes back into that wage figures, and that's what most people took out of yesterday. Most economists is that, there's a real tightrope going on, and at the moment, wages will be probably the sole reason the RBA is out of the market.
Well, thanks very much, Evan.
Thanks, Tony.
Join us again for the Economic View.
Did you know that your membership gives you access to InvestSMART, Intelligent Investor and Eureka Report? Just use your original login details on all 3 sites or go straight to investsmart.com.au, where you'll find all of our content no matter where it's published first.